This is an audio recording of the LendIt Fintech Weekly News Show. The show is streamed live on LendIt TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the LendIt News team and a special guest discuss the most important fintech news stories of the past week. Welcome to the LendIt Fintech Weekly News Show. My name is Peter Renton, Chairman and Co-founder of LendIt Fintech, joined as always by my good friend and colleague Todd Anderson. How are you doing, Todd?
I'm good, Peter. How are you?
Doing great. And back for, fifth, sixth, seventh time, we have Kat Utek from Core Innovation Capital. How are you doing, Kat?
Doing well, especially these days. Thanks for having me on again. This is going to be the most exciting one. Yeah.
Yes, wasn't it? Was it Confucius or someone who said, may you live in interesting times? Interesting times is what we are living in right now. And let's get right into it because, we have the big story, obviously, is the hit that the crypto markets are going through right now. And really, it seems to have been kind of precipitated by the Terra stablecoin, Terra USD. It's down 99.9% in the last week, and Luna, the stablecoin that was sort of paired with this, is also down dramatically. It used to be, I looked at Luna. It's now ranked to number 258 in coin market cap, and it used to be, I think it was top 20, certainly top 25 not that long ago, and it's just taken down the whole crypto landscape. It just really seems to have impacted everything, and some people say it's even contributing to the downward spiral in stocks. So thoughts, guys?
Yeah, I think on a plus note, there are still some good news in crypto, but I think there needed to be, as people have said for a while, there needed to be a correction, and I think you'll end up seeing a bunch of the good companies, and there are still really great companies. I know we'll talk about like Chainalysis, Raise, and some of the other ones. There were others, that there have been rumors for a while what's really behind them. And I think one of the hardest things in crypto, especially, there's very few people that are economic philosophers or mathematicians and that really know what's behind these coins. Right. And with all the flood of great talent, right? A lot of great talent in the crypto markets, there's going to be some projects and some companies that don't work out and that aren't built on good technology. So I think we'll see some of those get taken out. Hopefully there's not too much collateral damage on other types of startups, but I'm hoping that it gets kind of the tourist investors, kind of out and gets more serious ones in, and the good companies get funded, and there's not all this froth with companies that probably shouldn't be funded.
Right.
The thing I wonder is, does it have a knock-on effect for any of the other aspects of what's going on in crypto related to regulators or legislators? Does something like this not necessarily slow down, because I think we all are probably in agreement that we're on a path to some regulatory clarity eventually. But does this then give pause or have them change course in some way and make it more restrictive or make it harder for some companies and raise the bar that maybe if this doesn't play out the way it's currently playing out, the bar is maybe set here versus set way up here in order to be a market participant in whatever area of the ecosystem that you play in.
Yeah, Matt Levine has been writing about this extensively. He had another great column today that I was reading over lunch, and Matt Levine from Bloomberg, and basically he basically made the argument that these are things that just people believe in, and that's the only reason they have value is people believe in them, which is true for many assets, right? It's certainly not unique.
How many years have we talked about baseball cards or the memorabilia market on the famous, what was it, Brady, the $500,000 football,
right?
Thinking it was his last game. Inherent value has always been there for things if someone wants to pay for it.
Right.
Yeah. Beanie Babies, Pokemon cards, and you don't know what's going to go up and what's going to go down. So you have to realize what you're doing, and if you want to be a speculator or not in this kind of market.
Yeah.
So there are real companies. And to your point about the regulation, I mean, we need more clarity, and I think we've all talked about this for a while. I think they still have right. The regulators are still understaffed, and while they do want to regulate this, I don't think they have the right people, the right education, and I think it's going to take years more. Unfortunately, I think you're right that they are going to do some things and maybe enforce some things that they wouldn't have if there wasn't such a crash and so many regular consumers just didn't get hurt. And I think overall, if they start doing that, what I worry is that the best companies, and some are already not building in the U.S., will go abroad.
Yeah.
So hopefully, like they don't go a bit too far.
Well, that's oftentimes the way with regulators, right? They overreact. That's usually what happens. But speaking of which, our second story here was, Janet Yellen was appeared before the Senate Banking Committee this week, and was asked about what's been happening in crypto, and she says, yes, we need stablecoin regulation, and we need it quickly. She actually said by the end of the year she would like to see stablecoin regulation in place. The Treasury is releasing a report soon on crypto and stablecoins. Now, remains to be seen whether Congress can get together and agree on stablecoin regulation. That's often agreeing on anything is kind of hard a lot of times. But I think this is, as you say, it's going to precipitate some kind of change. Whether we just hope that it's not an overreaction.
Couldn't come at a worse time for the crypto market. Like, for a while there, it's like, they had these little Twitter spats with whatever CEO and the regulators, and that kind of makes for fun fodder. But overall, the crypto market, I think, has, by and large, been very much asking the regulators, like, come talk to us, give us clarity. Hey, we're happy to show you how things work and how our business runs. And then it's like, as soon as they put out the Biden executive order, a few months later, it's like crashing off a cliff. And it's like, timing is everything sometimes, I think.
Fortunately, the regulators don't move that quickly. So who knows if it'll be this year. And then maybe the market will be back up again.
It most likely will be.
Right. And I'll say that was...
I hope they're not regulating for cycles. Let's hope.
Yeah. Likewise. So, keeping with the bad news on for crypto, we had Coinbase. This I remember this when it came out. I think it was in March. The SEC basically said that all the assets that Coinbase holds, for their customers needs to be booked as a liability on their balance sheet, and that's what they've gone and done. And with that, they had to put in a disclosure in their latest quarterly filing saying that in the event of a bankruptcy, that is just a liability on the balance sheet, like all other liabilities could become. It may not be the customer's money. Now, Brian Armstrong said there's no chance of a Coinbase bankruptcy, which is stupid to say because there's a chance of an Apple bankruptcy. It's not zero. It's just unlikely. But the reality is, I mean, Coinbase is down. Like it was 80% in the last. I think it was either in the last month or it might be year to date. But I looked at their stats today. PE ratio, because Coinbase makes money. They lost money in the last quarter, but they made a boatload of money last year. Their PE ratio right now is 5.14. That is, I've never seen a PE ratio that low for a tech company. And I think I sold my previous company, a private company, for a higher multiple than that. So anyway, it's
so
crazy.
Are you buying, Peter?
Yeah, they're still worth like I think 11 billion or something. A little bit out of my price range, Kat. Anyway, thoughts on Coinbase?
You got to give the guy, Brian Armstrong, a lot of respect for building it so big and something from nothing. And he's probably taking a lot of flack given just the markets in general. Again, this is a long-term game. So short-term hit, right? They're I think, doubling down on the crypto market and Web3. I know some people are critiquing that, but you have to believe that like he's grown it this big and that he knows maybe what might be best for it. So time will tell, but I think it's, I think he's worth betting on, and there's nothing that he's done before that you're like, okay, this, let's bet against him. So I'm hopeful that they'll rebound.
Mm-hmm. It was the same guy that also came out with the letter saying that, essentially when you're at work, the mission is the Coinbase mission. and we need to stick to that mission, which got him a lot of flack. And then there was a slow turnaround. Then all of a sudden, people were like, "Wow, maybe we should have taken a similar stance." I.e., Apple and the lawsuits that they're constantly going through. But I'd say, for short-term pain, I still wouldn't bet against him long-term.
Yep, agreed. Okay, so moving on, let's talk about Tiger Global. They're in the news this week. Tiger have been one of the top investors in tech and fintech as well for many, many years. And apparently they have had I presume it's just a book loss of $17 billion year to date. Now that's hard to do, but they've erased, get this, 2/3 of their gains since 2001 have been raised this year. But they still, they just closed their 14th fund in March, raised $12.7 billion for that fund. So, I mean, they've got money. And, like some of the stats are just crazy. They added, I don't know what the total is, but they in 2021, they added 118 unicorns in their portfolio. So, I mean, it's a little bit bigger than core innovation, I think, Kat. But what are your thoughts on Tiger?
Just a bit. I was going to say, here's some other guys I would not bet against. The guys at Tiger, they lost more money than I think, probably 95% of venture funds altogether will never make. And they still have made, even losing that money, more than 95% of venture funds will probably ever make. So, I still see them active in market. We've seen them, I think we talked about this, them going kind of looking, even earlier stage. They have enough, cash to do earlier stage deals, and they have enough cash to double down when those companies are doing well. All my experiences, these guys have a ton of money, but they're also some of the most responsive investors. When you send them something, they look at it, they get to it. I don't know. These are other ones I would not bet against. And, they're just, the whole market's getting hit across a lot of different categories. So it's hard not to take that hit. But I'm thinking this is going to be temporary. And I do not feel bad for the guys at Tiger. They will be okay.
Right. Okay.
I mean, they're the type of firm that takes the outsized swing more than anybody else does. So when things go bad, they're going to be the ones that take a bigger hit, yet they're the ones that have the biggest wins at the same time. And so it's, I mean, you heard this a lot the last couple of years, how many rounds Tiger was involved in, of the earlier or of the type where they kind of just came in over the top and said, all right, here's your valuation, here's your money, and move on. And I think they're feeling some of the pain from that. But like Kat said, I don't think it's going to change much of what they do. Maybe they don't make as many outsized bets this year, but long term, I don't think it's going to change that much.
Yeah, it reminds me of the .com crash where, like the Googles and Amazons kind of came out of that, where some of the largest companies on the planet now, and but pets.com didn't make it, and many other companies didn't make it. So there'll be a culling of the herd, and I think in crypto and in fintech, and I mean,
in some ways, some of this is good.
Yeah, it is.
I mean, it's painful and going through it, especially for companies that probably get hurt as collateral damage and probably don't deserve it in some ways. But in the end, it's the strongest, best run companies with the best boards, best investors, and best executives are going to 99% of the time win.
Yep.
Yeah, well, no, I think there's going to be a little bit more collateral damage in that. But the good, I feel awful for a lot of these employees that were at these companies and were really counting their money in their head, which is why you shouldn't do that until it's actually in the bank.
Right.
But I do think, though, there's still so many great companies being built that, when these layoffs happen, which for an individual team member, I could imagine would be brutal, especially when it comes from nowhere. That there's so many other great jobs and so many, I know so many of our portfolio companies are hiring, there's so many people hiring in the market that I do think, again, it'd be painful if you were somewhere for years and now your stock's barely worth anything. Your RSUs are underwater, right? Like all of that is not great, but they can get other jobs. I think there's still so much innovation happening. There's going to be a lot of great companies that come out the next decade. So it's, going to be a swift transition for people, but at least it's not like, I don't think when people get laid off, they're not going to easily fall into something else. And I think the community has been really good about rallying around the people that are laid off and making sure they get into good places.
Yep.
I mean, just look how early we still are in Web3 and how early we still are coming out of COVID and kind of the next fintech wave. I mean, there's a lot of talent and places for people to go. In the moment, it's hard, but I agree that there's a lot still for them to latch onto in the market that hopefully they can rebound pretty quickly.
Okay, so let's move on to a good news story. And it was interesting. Chainalysis, who you touched on, Kat, earlier, they announced a new funding round, 170 million at an $8.6 billion valuation. Interesting, they decided to go with it anyway, like this week. I think it was announced yesterday. It might have been Tuesday, but it was this week anyway. And that was, I think, good for them. It's good to have and they're a picks and shovels type of company. They don't really depend on very much on the price of crypto, because they said they monitor $1 trillion in crypto transactions a month. That's really impressive. I hear them all the time. Like we hear them with with stuff that's going on with Ukraine and Russia. I just hear them around whenever there's some sleuthing to do about where transactions came from. Chainalysis seems to be involved. They have 700 people now. They got a presence in 70 countries. They seem to be crushing it.
Shameless plug. They are a sponsor of LendIt as well, especially in our LATAM event. But I mean, this is the type of crypto associated firm that is obviously benefiting from a lot of the stuff going on in the market. And they've always performed kind of somewhat under the radar. I think the under the radar part is gone now with this raise, but they have a lot of quality people over there.
Yeah. Okay. Moving on. Let's talk about the CFPB. This is an article in American Banker this week. Basically, Director Chopra's expansive vision for CFPB authority is facing industry pushback, and he does have an expansive vision. And he's already taken on a few companies, and companies are not just taking this lying down now. I mean, he's basically announced a whole bunch of enforcement actions, and companies are saying, I'm not going to pay this fine. I'm going to sue instead. And so, the banking industry, there was an op-ed in the American Bankers Association, the American Banker from the head of the American Bankers Association, or one of the executives there, basically claiming that CFPB is overstepping its authority. CFPB has always been a controversial agency since its founding out of the financial crisis and Dodd-Frank, but they certainly are not making any friends in banking or in fintech. We are on the same team, it feels like, when we're talking with the CFPB there.
Yeah. I mean, like you said, they've been controversial for day one. Like, should they exist? Should they have the authority they do? It's interesting to watch them go after individuals now and not just the companies, and have people go personally responsible, which I think they said they put for some CEOs. I think, there has to be checks and balances in all regulation. I understand why the CFPB exists. And it's a lot, overarching to protect consumers, but you do have to make sure that they don't overstep, because they can stand in the way of innovation. And not all of this is, especially as we're building stuff, it's not all perfect. And I think people are genuinely trying to help consumers. And if, fintech is really sad that it has gotten a bad rap lately, because I think if all these fintechs didn't exist, a lot of poor people would be even poorer. And it was very expensive to be poor. It still is. I think it's gotten a bit better. And if you have, 1% of bad actors, fine, but to drag the other 99% down when they have so much more advancements. Right now, people have options that were underbanked or really paid high fees. Think about what Dave and Chime and Bridget did to really get rid of all the overdraft fees. So it would be nice to see them take a more balanced approach of, okay, people need to try things and they're not out to get the consumer. we'll see if they strike that balance, but it doesn't seem like it right now.
Man.
It seems like they always have the response of there was like this ill intent behind something versus, when you're building and innovating, things are going to break accidentally or there's a result of something that you didn't foresee 3 or 4 steps down the line. And the CFPB has always been more on the side of, well, you must have intended that from the start to make more money or to deceive someone. And I just don't, in some of it, I don't get it. I just don't know how that benefits them long term either. It's like they keep on putting themselves in the fire for what could be seen as like these silly mistakes. And a lot of it seems to end up being in the end political to get in front of the cameras and make it seem as if they're doing all these things when in reality it's, this game that they're playing.
Right. It's a game with massive consequences, and that's the problem. So, anyway, moving on. This article caught my attention in Forbes this week. Hadn't really thought about this too much, but it's talking about high interest rates. The title is "How High Interest Rates May Upend the Fintech Business Model," and basically the premise is that digital banks have been around when interest rates are basically zero. You didn't need to pay anything for deposits, although some fintechs have from the get-go. And account switching, we've never had a high interest rate environment where account switching is so easy. You'll be able to go and just move your money from one digital bank to another digital bank in just a matter of seconds or minutes. And are we going to see a time where like the bank people go to bank rate and the top 3 hits on bank rate just continually get more and more revenue, more and more deposits coming their way? And it's just an interesting thing to think about. This article claimed that traditional banks now have have a similar user experience, and they have a long history of trying to of attracting deposits in all sorts of different types of environments, and whereas fintechs have really not been around trying to attract deposits in a rising interest rate environment. So I thought it was interesting.
Yeah, now with all those, account switching companies, and we're biased, we're invested in one that we love. That's one of the reasons we did, so you could easily switch accounts and you're not stuck. But I think it's just like how some people love points and maximizing their credit card points and every type of like flight point.
Peter.
Like
Yes, I do.
Yeah. I mean, some people love that, and other people are like, oh, I don't want to be bothered. If your bank account is at the same place for like a decade, I don't know if you're going to switch for like going from 2% to 3%. And I'll be surprised if the interest rates, and we'll see what happens, but in the banks hit like 3 or 4%. And if you look even at the traditional banks now, even though the Fed raised the rates, you don't see the interest rates really rising, in the banks. And I think you would see that if they were really like hemorrhaging lots of customers. So I think the people that are going to be at the traditional ones, great. And the ones that are at the fintech will stay there. And I can't see it becoming like in the 80s. Remember when you could do a CD and get paid like 15 or 20%?
Right. Well, you could do like savings bonds and you get paid like 14.5%, government backed.
Yeah. I don't know. I don't think we can get to that point because we have too much debt as a country. So it'll be interesting to see though if it does affect fintechs.
Probably affects the earlier stage companies starting now more than it does some of the companies that have been around for a while.
Yeah, but the question is, do we really need another neobank?
No.
Do we have enough?
I mean, I guess if you want one that caters to people who love sneakers, one of those. I mean, there's all kinds of affinity groups that I guess we haven't thought of yet.
You could, general partners of VC firms, you could sort of trade a neobank just for that.
SVB, First Republic, they already have it covered. That exists.
Well, there you go.
All right. What's next?
Yeah. Well, but like the thing is, I think, it's going to be hard to create a new digital bank from scratch unless there is you've got some sort of hook these days. Because there's so like Chime has a huge penetration, Varo, Dave, these are now established companies with millions, in Chime's case, like tens of millions of customers. That's a hard hard place to go compete against. So anyway, moving on. We don't normally cover executive moves, but this one is really interesting. This is someone we know well, and he's a very high profile person. Terry Angelos. He was head of crypto and fintech. He used to be just head of fintech, and they added head of crypto and fintech, I think, last year. And anyway, he's spoken at our event, at multiple events many times, and he has left Visa. It seems to be in an amicable way. And he is going to be the CEO of DriveWealth. Bob Courtright, who I had on the podcast just a few months ago, is stepping back from being CEO, and he's going to be chairman. And Terry Angelos is coming in to be CEO.
And
I know
you've
been in conversations with Visa.
And he will be speaking at the event in 2 weeks as well on why every bank needs a crypto strategy with the CEO of Silvergate Bank. So, I mean, we know Terry well. He does a great job. I think it was a surprise to see him move, considering how long he's been at Visa. It feels like he's been a staple there. But, interesting to see where DriveWealth goes from here.
Yep. Congrats, Terry.
Yep. Okay. So this just came out just before we went on air, and I'm putting it in here. We haven't had a chance to really read into it, but SBF, Sam Bankman-Fried, the founder of FTX, multi-billionaire guy. Apparently, he has been gobbling up shares. He had to do a regulatory filing. He probably did it on time, unlike Elon Musk, I'm guessing. But anyway, he now owns 7.6% of Robinhood, and of course, in after-hours trading, Robinhood's shares are popping. Of course, they've been in the doldrums pretty much since the IPO, but certainly in the last month, they've been hit hard. So, SBF is obviously likes Robinhood, I guess.
Everything SBF touches these days is apparently gold. So,
except I heard his wealth now is down like 50%. He's still okay. Like, again, I'm not too worried about him either. Yeah. But just from a lot of the crypto crashes, I heard it's down about 50%.
Yeah.
I don't know. It would be interesting to see though if someone comes and swoops up Robinhood or any of these other companies that are so inexpensive. Compared to what they were and maybe what they should be and what their fundamentals are. So it'd be super interesting or to see if someone ends up taking, some of these guys private.
Right.
That would be very interesting.
Yeah, because some of the SPAC companies from 2021 are down 90%.
Crushed.
And I'll be shocked if there's not multiple acquisitions between now and the end of the year of some of those guys, because they're really, they're not, some of them aren't making money, but they've got a decent customer base. Like Moneyline has 4 million customers, and they're worth just a fraction of what they were worth, a year and a half ago.
Yep.
Yeah. Anyway,
that's good lessons for companies that are on the way up now, and when to go public, when not to go public, and some good lessons out there.
Those companies that stayed private, it's a different world now if you want to go public, and I think there won't be many IPOs anytime soon, but clearly it's a different world now. And and overall, as we've talked about, this is not necessarily a bad thing. Anyway, that wraps it up for today. Before we go, we have to remind you, 2 weeks, it's LendIt Fintech USA, soon to be Fintech Nexus USA. You heard it here first, potentially. We're doing a rebrand, in case you didn't know. We're doing a rebrand. It's actually happening next week, and we are happening in New York. There are still tickets available. It is going to be huge. We have broken records with number of sponsors. We're on track to break records for attendees. So, still tickets available. LendIt.com. Go check it out. Anyway, thank you, Kat, as always. It's so great to have you on. Thanks, Todd. And we'll be back same time next week.
Thanks, Peter. Thanks, Kat.
Thank you.
See ya.